with any retailer, when they're in this situation, the end game, if it's a liquidation, is not a positive. I think we all like to see the company survive, and there can often be a better recovery if the company actually survives. In the case of Sears, that's an open question right now. It just depends on what the creditors want to do. And what we've seen, we certainly saw it with Toys R Us, is a creditor class pushing for liquidation, and that's exactly where we ended up when a lot of folks thought there would be a restructuring with Toys R Us. So it's kind of a mixed bag right now, and we're in early days. There's a lot of innings left to play here with respect to the bankruptcy process. So I think we have to just stand back and wait and see.
Liz, you know, at one point Sears had, I think, something like 4,061 stores at its peak, and now has just about 700 stores. Clearly, it's a lot smaller than it used to be. $53 billion in sales at its peak, now somewhere around $16.7 billion. But if you are a mall operator or you're one of the tenants around Sears, are you really disappointed that they're leaving? And I say that after speaking with a number of folks today, including Stephen Lebovitz, who is the CEO of CBL Associates. They have shopping centers and malls with Sears in them. And he said, look, we've reconverted and redeveloped several. One of them gets 4 to 5 times higher rent than what Sears was paying. Is this really a bad thing for the mall?
I think it's not a bad thing for many of the malls that Sears operates in. To your point, higher rent, but also higher productivity and a bigger draw. I think the days of Sears being an anchor tenant that really drew traffic into malls are long gone. And so if malls can attract better tenants that will be a draw for consumers, I think that's a win-win, particularly if they can, if they're paying higher rent.
Sears holders lose, Charlie. What retailers win?
Boy,
by category or name.
If you're selling appliances right now, you're positioned well. So that's Best Buy, Lowe's, Home Depot. And if you look at what's happened to Sears market share in appliances, 15 years ago it was roughly 40%. Now it's a heck of a lot less than that. It's been siphoned off by those three predominantly, Home Depot and Lowe's, because they built a lot of stores. So that's really where I think you'll see a lot of it. On the electronic side, Sears has a business. Best Buy picks up a chunk of that. Walmart picks up a chunk of that. The toy business with Kmart and Sears both had reasonable toy businesses. That's up in the air, as well as the Toys R Us share at this point. But, you know, the usual suspects on that front: Walmart, Amazon, Target, Costco potentially, Kohl's potentially. So there are a lot of folks out there positioned here to benefit from $11 billion worth of revenues being up for grabs.
It's not going to be, though, as big of a share shift, though, Liz, as when we saw Linens and things go out of business, benefiting Bed Bath & Beyond, or Circuit City benefiting Best Buy, is it? Right.
Yeah, there's a wide bunch of retailers that will benefit from Sears going out of business. I think there is some business to be picked up on the softline side. Both Macy's and JCPenney's have significant overlap. I think a third of their store bases, respectively, overlap with Sears. You also have the off-price retailers. But, you know, to the point about the hardlines business, that business has really shifted away from the malls, and it will likely fall to some of those other retailers mentioned. So I think it's not going to be, it's not a situation where there are two really strong competitors, or one strong competitor and one weak competitor, and the one goes away. This is a situation where it'll lift a lot of tides for a lot of retailers.